Hello, I'm Séverine Sibeli. Thank you for joining us for today's Scientific Beta webinar. Today we will be presenting several articles that appear in the latest EDHEC Research Insights supplement to Investment and Pensions Europe. First, a presentation on robustness and smart beta strategy made by Dimitris Korovilas, investment specialist at Scientific Beta. Then a presentation on the value definition by Felix Goltz, research director at Scientific Beta, who will be joined by Ben Luton, quantitative research analyst at Scientific Beta, who is co-author of the article. The third presentation will be on carbon intensity bumps and made by Frédéric Ducoulombier, ESG director at Scientific Beta. Then Eric Christiansen, ESG and low carbon investments specialist at Scientific Beta, will be presenting an article on ESG engagement and investment. And finally, Daniel Aguet, Index Director at Scientific Beta, will be speaking about the benefits of the historical adjustment risk control option. We always like to hear from our viewers, so if you have questions on any of the topics, you can use either the Q&A function or the raise hand sign at the bottom of your screen. We will address the question at the end of each session and also at the end of the webinar. So I will now hand over to Dimitris for the first presentation on robustness of smart beta strategies. Thank you.
Thank you, Severine. Let me try to move the slides. Okay, cool. So the first paper is about the discussion of why it's important for investors to assess the robustness of their strategies. And the reason this is a relevant topic is because usually we see in the marketplace smart beta strategies or multi-factor strategies that some of them, for example, experience an out-of-sample degradation of performance, or others start to behave out of sample differently from what they're supposed to behave based on what they were given on paper. So the reason that this is the experience we see in the marketplace is that many of these multi-factor strategies suffer from a lack of robustness when they are designed. And in this paper, we try to discuss some of the common sources that lead to a lack of robustness in the index design. And we also give the methods by which Scientific Beta improves robustness in the construction process. Now, if you put robustness in the forefront of your index design, in the multi-factor space, you will get indices that benefit from good factor exposure quality. And good factor exposure quality means that you have multi-factor indices that have both good factor intensity and good factor diversification. And this is essentially your ticket for increasing your confidence in the out-of-sample period, increasing your confidence that your strategy will not be strongly conditional dependent in certain market situations, and also about the out-of-sample outperformance. Now, beyond the index design discussion, we want to offer investors the quantitative tools. We want to offer them measurements to assess robustness quantitatively, because this is also very helpful, and sometimes you're not able to see behind the curtain on the index design phase, and you want to have some tools to assess robustness quantitatively. We will, and in this paper, we also present some output from these measurements using popular indices in the marketplace, and we see whether the lack of robustness that we spot in the index design phase, if it also pops up in the quantitative tests. So very quickly, trying to move one slide. Yep. Here, so in the index design phase, in this table, there is a quick summary of all the problems on the left-hand side. There is a representative example of lack of robustness in popular products in the middle. And then there is on the right-hand side, the methods by which Scientific Beta improve robustness. And on the left-hand side, the problems with robustness comes usually from problems in the factor definitions. You have strategies falling in the trap of factor fishing and factor redundancy, picking up factors that are not backed by economic rationale, or picking factors that are really explained essentially by other well-rewarded factors. And this can lead to robustness problems. You have model mining issues, providers changing their index methodology as it suits, having contradictory products under the same label, etc. The third problem is usually you see strategies that have high exposure to unrewarded risks, and this can prove you can be lucky in a certain sample, but over the long term these idiosyncratic risks are unrewarded, and they contribute to a lack of robustness. And the fourth main category is that, especially for multi-factor indices, you see often such indices to be strongly dependent on one or two particular factors. You're not really talking about well-diversified multi-factor products. And I'll just talk about it a little bit more. And for example, in the middle column, I have an example of a strategy that essentially is not a multi-factor strategy, is essentially a single factor strategy which aims to reduce negative interaction with two more factors. So at the end of the day, you are not well diversified across the 6 well-rewarded factors. You are really taking exposure, taking factor bets in a couple of factors. And the way scientific beta improves this problem is by using our high factor intensity filter, whereby at a single factor level, you reduce exposure, you reduce negative exposure to the other well-rewarded factors. So once you combine these single factor sleeves together in a multi-factor allocation, you get a product that has strong factor exposure across all the factors and well-diversified exposure across all the factors. And this is trying to move on to the next one. And this is when you measure robustness, moving now into the tool set. When you measure robustness, that's the first thing that you should look at. You should look at the factor exposure quality, which is, as we said, the product of factor intensity and factor deconcentration. So it's a combination of how strong your factor exposure is and how well diversified. And here we have the results for all these popular strategies in the marketplace, and you can see in the average column that they lag behind in terms of exposure quality, they lag behind in terms of intensity, in terms of deconcentration with respect to the scientific beta indices. And what this really means is that you may be exposed to, you may have a multi-factor strategy that is by luck exposed to the correct factors in the particular sample, and in the particular sample these factors worked well, but that doesn't mean anything about the next period. The next period, it might be some other factors working well, and you will not be exposed to them. So your ticket for long-term robustness and out-of-sample performance is to be diversified across factors and with strong factor betas. And moving on to some more results from these robustness measurements, they help you also identify issues with conditionality. You can see here the main categories. You have, you can measure the conditionality of your strategy to the market, to factors, to sectors, and you can identify if your strategy is strongly dependent on a particular market situation or not. And you basically, for multi-factor strategies, you want as much as possible this conditionality to be low. We offer here a metric called outperformance probability. It's basically an empirical frequency of how often you outperform the benchmark, and this helps you go away from the problem of fixed entry and exit points. Basically, it's a rolling measure and allows you to see how often you outperform irrespective of particular entry and exit points. You can see extreme rolling statistics. You can see also the robust inference test, which is important because it allows you to examine whether an in-sample Sharpe ratio difference is really significant or not. It's an econometric test. It tests for data mining problems and allows you to see if your Sharpe ratio, if your in-sample Sharpe ratio difference is really significant or not. Aware of the time, in conclusion, in this paper, you can see that popular multi-factor strategies at the end of the day remain at deficit compared to scientific beta, strong factor intensity and strong factor exposure quality. And the main reason behind is the use of the HFI filter that allows for this well-diversified and strong factor exposure. Now, if you don't have these qualities, you may be lucky and your multi-factor strategy may be exposed to the correct factor in the particular sample. But over the long term, this non-explicit bet is against you in terms of robustness, and usually it's not well documented at the beginning of the process. In this paper, you will also see the measurements of robustness that I briefly discussed, and you will see a quantitative evaluation of multi-factor strategies in the marketplace that allows to see quantitatively and spot the problems that are already there through the index design phase. And Severin, yeah, at this point, I'm concluding with a quick presentation of this paper.
Okay, thank you very much. We just have received one question. You mentioned that well-diversified portfolios can help reduce exposure to unrewarded risks, but how do you actually achieve diversification?
Yes. Okay. So one of the problems that we discussed in the index design phase is getting exposure to unrewarded risk, and the solution to this is obviously to create well-diversified portfolios. And to do this, you can pick a weighting scheme. You can pick a diversification model. So what we do at Scientific Beta is we try also to manage the model risks of picking a well-diversified model. So in practice, we use 4 weighting schemes. Each of them has particular benefits and works well in certain conditions. And by combining them together, taking the average of these 4 weighting schemes, we are actually not only diversifying the portfolio, but we are also diversifying the model risk of the diversification model. And very briefly, these weighting schemes is the rank from the simple equal weight to 2 models that equalize the risk, and the 4th model that is as close as possible to the true max Sharpe ratio model. So with these 4 different models, combining them together, you can create a well-diversified portfolio and avoid these unrewarded risks.
Okay, thank you, Dimitris. We have just received another question. What is the analysis? Why is the analysis only until 2019? Because the COVID behavior would be interesting to see.
Yes, so this was an earlier version of the paper we did before the summer, sometime in spring, and later on for our conference. I think people that logged into the Scientific Beta conference in autumn time, we had expanded this analysis to most recent data. So the conclusions are the same. So
okay,
yeah.
Okay, thank you very much. That's all for the question, and so it is now time for Felix to make his presentation. Felix, can you access to the slide? Yeah.
All right, so I will focus on a recent criticism of value investing and the value factor in particular. And so there's a lot of criticism that has appeared over the past couple of years, and book to market has clearly come under severe attack. Now, this is a big deal because book to market is really the standard definition of the value factor. So going back to the 80s, academics used to define the value factor by the book to the market value of a stock. And this is still what is used in most of the models. And this is essentially what the evidence of the value factor is based on, but this is also what the theory of the value factor is based on. So we're clearly in trouble if the book to market ratio is in trouble. And so claims clearly are that book to market now is quite misleading. It doesn't give a good reflection anymore of what we're trying to capture with the value factor. And the argument behind this criticism is basically that the book value of a stock just omits a lot of the investments of a company. And you can take the example of a young technology startup to illustrate this. So if you take Microsoft, for example, when it first started back in I guess the early 70s. So what was the book value of Microsoft back then? By standard accounting rules, an accountant would probably have said, well, this company seems to own a garage. Okay, so that's the physical assets the company has, because only tangibles will appear on the balance sheet, and accounting rules are very conservative with respect to intangible assets. So if there's software under development, if there's knowledge capital, this will typically not appear in accounting statements. So most of this will be absent from the balance sheets. And this might not be a severe problem if intangible capital is small, but economists now estimate that intangibles account for about 1/3 of firm capital across listed companies in the US. So clearly it seems that the book value is missing a lot of company investments. So there's clearly a problem, and we've clearly moved on from the pre-Microsoft days. Accounting rules perhaps not so much, they haven't changed so much. So the question then is, what do we do with this problem? And there's essentially two answers to this problem. So the first answer is what you find in the industry. So many index providers argue that you need to move away from book to market, and so you should look at other metrics like sales to price, cash flow to price, earnings to price, and similar metrics. Now these metrics, of course, don't use the book value, and they may be a lot less influenced by accounting rules for intangibles. Some of them will still be influenced. So you can imagine that earnings will be influenced by how you deal with investments that you do into intangibles, whether you actually expense them and they will reduce earnings, or if you actually account for them as accumulating capital stock that would reduce earnings less. So these measures are not completely immune to also these accounting biases, but clearly they will be less exposed than book to market. Now, academics have come up with a different solution, and that solution seems more straightforward. So the idea is just to say, okay, we are missing something. Book values omit a part of firm investment. So rather than doing away with book values, maybe we can just try to measure them properly. And so even though accounting rules may not be appropriate, we can make adjustments and we can figure out what the intangible capital is that basically accounting statements should carry if accounting rules were more sensible and less conservative. And so there's two items that you can estimate. So there's organization capital and there is knowledge capital. So both of these make up the firm's intangibles. So if you think about organization capital, you could think about, for example, say a business consulting firm. Okay, so these firms will have done investments into their workforce, into their customer relationships, into their brand, and all of this makes up organizational capital. Now you can estimate that from the corresponding expenses. So part of the selling, general, and administrative expenses shouldn't be expensed. They should be counted as investments into intangible capital and they create organization capital. The second element is knowledge capital. So knowledge capital here, as an example, you could take a biotech company, say a company that develops a therapeutic. So clearly, the expenses of R&D to come up with these new drugs that will heal diseases, well, that should not just be directly expensed. We should account for this as accumulating knowledge capital in the company. And so we can actually do this. That's quite standard measures. You just go to the accounting statements, you look up the expenses that shouldn't be expensed, for example, R&D expenses, and you just capitalize them, and then you depreciate them over time. So this is exactly what academic papers have proposed. We're just drawing on this, and so we were interested in comparing these two approaches. So which one is actually more promising? So we published this research in a paper in the Journal of Portfolio Management. So that appeared in July. And here I'm just going to give you a brief summary of the key results in this paper. So what do we find when we compare an intangible adjusted book to market value factor to other kinds of value factors that people have come up with and that are widely used in the industry? So we're showing here the annualized factor returns. So first you have the book to price, then the intangible adjusted book to price. We call that I book to price. So here we just add the organization and knowledge capital back to the book value. And we're comparing that to popular measures such as sales to price, earnings to price, dividend to price. We're looking at cash flow to price, and we're looking at combinations of these measures. So these are probably the standard way in the industry among index providers and portfolio managers to define value is to have some kind of composite that may or may not include book to market, but that will combine different valuation metrics. So you can see that moving away from the traditional book to price can be attractive. So sales to price, for example, earnings to price have much higher returns, 4% annualized, for example, for sales to price. So that perhaps explains the popularity of these alternative measures. The book to price indeed looks relatively poor. So this is US data starting in 1976. That's when we start to have data to estimate the intangibles. And so if you look at the intangible adjusted book to price, you can see that this also adds value in the sense of a higher return to the value factor. Now, looking at the standalone returns is not particularly meaningful. So what we're really interested in is what is the value added in a well-diversified portfolio. So if an investor already has access to a set of standard factors, what is actually the value that he gets out of having access to these alternative value definitions? How much performance does that actually bring to his portfolio? And so this we can estimate with a multi-factor model, and we're just looking at the return level that is unexplained in this multi-factor model. So we plot these unexplained returns here. You can see that measures that look very attractive, like sales to price and earnings to price, they do not actually add any value if you account for their interaction with some of the other factors. So sales to price, for example, has an unexplained return which becomes negative, about -1%. Earnings to price also has an unexplained return which is very close to zero. Again, compare this to the initial results. If you just look at the standalone returns, sales to price and earnings to price actually looked attractive at something like 4 to 3%. Annualized returns, this actually becomes close to zero when you account for the other factors. What's happening here? Well, a very simple thing is happening. So you can see in the blue bars the exposure to the profitability factor. So using, for example, the sales to price will expose a portfolio to the profitability factor. So you're loading on stocks that have actually high exposure to profitability. And that obviously doesn't have any value to an investor if you already have access to a profitability factor. So this doesn't give you a better value definition. It just gives you, value plus profitability. So you're not actually gaining from this if you're a multi-factor investor. The results are very different for the intangible adjusted book to price factor. So you can see that the unexplained returns are significant, they're positive, and they're quite sizable. So you get a 2% unexplained return when you conduct this intangible adjustment. So there's a pretty straightforward conclusion from this empirical analysis, and that's clearly that drawing on alternative valuation measures and combining them in composites doesn't actually add any value in a multi-factor world. So if indeed book values are flawed because of this accounting conservatism, we can do something about it. We don't have to move to these alternative valuation ratios, which don't add any value. Instead, we can stay with book to market, and we can make sure that our measure of book value actually includes organization capital, and it includes knowledge capital. We can estimate these from accounting data. And we've seen that this type of adjustment actually strengthens the value premium. So we can be both more in line with the evidence that we have on the value factor, with the theory behind the value factor. So we can stay with book to market, and we can just improve results and extract a much stronger premium simply by improving the measurement of the book value. So indeed, it's much better to directly address the problem with omission of intangibles and include it. And you don't actually have to forego or give up on book to market. So book to market remains a relevant measure, despite all the criticism that you see. Book to market is a relevant value metric. You only have to make sure that you measure this correctly and that you do include the intangibles in the book to market. Thank you very much for your attention.
Thank you, Felix. We have received one question. Have you tried including the intangible adjust book to price in the composite measure?
Yes, thanks for the question. So maybe to start to give the short answer, yes, we tested it, and in the end, it doesn't lead to any different conclusions than looking at the composite measure, as we just showed in the presentation. Giving a bit more detail. So what we specifically did is we looked at similar factor models, as shown in the presentation, where we were going to see whether adding such a composite measure, where the book value is adjusted for intangibles, to a multi-factor portfolio, where the value factor is actually presented as the intangible-adjusted book-to-price factor. So we tested whether adding this composite value factor to the portfolio actually adds any investment value to the investor. And we clearly saw that there is no additional information once this other set of factors is already included. And perhaps more interestingly, looking at it the other way around, when the starting point is a multi-factor portfolio with such a composite value factor, we see that an intangible adjusted book to price factor still adds value to such a portfolio. So that basically leads to the conclusion that all the information that is represented in this multi-factor set where value is the intangible adjusted book to price factor, that actually includes all the information that you might possibly find in a composite value factor. And that doesn't add any value anymore to your portfolio. So in the end, the same issue remains whether or not you include for intangibles in this composite. And this issue is that it's going to lead to a factor overlap with other factors such as profitability, which in the end lead to no extra benefit for a multi-factor investor.
Okay, thank you very much. We have received another question. Can you provide an example of organization capital, please? What would I take from SG&A expenses?
So I think one very common example within organization capital would be the brand capital of a firm. So firms, of course, they invest in advertisement to build up their brand value. Think, for example, about a company like Coca-Cola. Their advertising costs would typically be expensed, but it's hard to argue that a brand like Coca-Cola is not a substantial asset of this firm. So in terms of the estimation procedure, we are a bit constrained to using SG&A because of the data we have available, because of the reporting we have available. It's not always possible to extract all these detailed informations. So we really just follow the academic literature, which has done some thorough research to make sure that this estimation method represents organization capital as a whole well. and we follow those methodologies.
Okay, thank you. I think we can move on to the next presentation. Frédéric?
Are you seeing me?
Yes.
Okay, and the slides.
And your slides, yeah.
Thank you.
Thank you.
So the motivation for this short article is simple and is related to recent regulatory activity in the European Union. In 2018, the Action Plan on Financing Sustainable Growth defined the reorientation of capital flow towards sustainable investment as one key ambition. And in November 2019, the creation of the European Union Climate Benchmark was the first initiative of the action plan that was passed into law. The delegated act that details the standards for climate benchmark was published last week, and it does impose decarbonization by a reduction of the weighted average carbon intensity of the portfolio relative to the market benchmark, which is a classic, which is a mainstay of low carbon indices, but it also requires decarbonization via contraction of the weighted average carbon intensity of the portfolio year after year. And this is rather new and innovative. And the objective, the overall objective is to put the index on a pathway that is consistent with the Paris Agreement. So reduce the emissions in the economy. However, we find that the regulation has substituted enterprise value for revenues for normalization of greenhouse gas emissions. Normalization by revenues is the market standard, and when the TCFD looked at carbon metrics and with average carbon intensity, it also used normalization by revenue. So we study the consequences of this variation. So first, and that's a very straightforward and simple observation, enterprise value is not defined when the company is not listed, because it is the sum of equity market capitalization and value of debts, and obviously the equity market capitalization is not available if the company is not listed. So as for this issue, the technical expert group that advised the Commission suggested using book values, but respondents in calls for feedback, such as Scientific Beta, underlined that this would be favoring listed companies. This would create some geographic biases in relation to access to capital markets and some sector distortions as well. So the TEG changed its view and suggested that absolute emissions could be used as an indicator for decarbonization. In the end, the European Commission decided to allow the use of absolute emissions for debt securities of listed companies and to impose it for debt securities of unlisted companies. So in the end, you have two metrics, absolute emissions and weighted average carbon intensity, that are used in the regulation, and inconsistencies even within debt benchmarks. Had we stuck to revenue-based intensity, we would have kept a metric that was computable whether or not the company is listed, and applicable to both corporate equity and fixed income. So the gain in terms of transparency is not obvious. Also, when you normalize by enterprise value, you introduce market biases. The justification for normalizing by EDHEC given by the TEG was the desire to hit the coal industry hard on the head. This because the valuation multiple would be depressed by stranded assets. So it's not obvious that we need to be incentivized to exclude coal. It's become a mainstay of low carbon indices to exclude coal. But anyway, if coal is to be targeted, it's probably preferable to target it directly rather than indirectly by changing the metric, as this will have consequences on other sectors. By nature, enterprise value will favor those companies that have higher growth, higher profitability, and lower risk. So there will be losers and winners from the switch in metrics. So I graphed here the list of companies with enterprise value to sales ratio that are lower than the average, the market average. So these are the companies that are losing from the switch. And to the extreme left there in red, you have the coal industry, indeed suffers significantly. That was the objective. But you have all these other industries to the right that are also suffering from the change. The second graph here shows the companies that are benefiting from the change, and the technology companies, but also the financial companies are very advantaged by that change. So we're seeing biases linked to the capitalization of sales being introduced in the measurement of carbon intensity. More of a problem is the introduction of market volatility in the carbon intensity measurement. And interestingly enough, the TEG was initially very reluctant to include market capitalization in metrics. It's correctly underlined that this could create some misleading results, whereby you would observe a fall in the carbon intensity, even though there was no change or possibly a rise in the emissions. This, by the way, does not disappear when you adjust the carbon intensity or adjust the enterprise value used in carbon intensity by a factor reflecting the overall change in the market, because there will be companies and sectors that perform stronger or weaker relative to the market. So those with positive momentum will be advantaged, and those with negative momentum will be suffering. And as a result, the benchmark competition over the year, when you need to decarbonize by, technically it's 7% year on year, may be driven primarily by market effects, by this equity market volatility, rather than by changes in emissions. This shows you the distribution of carbon intensities measured relative to revenues or enterprise value. And what you see, the revenues version is blue and the enterprise value version is red. The distribution when using enterprise value is much more spread out. There are more observations at the center of the distribution when you use revenues. More than a fourth of the observations are within 5% changes year on year when you use revenues, and less than 15% when you use enterprise value, including cash, for the same emissions changes. If you look precisely at what happens to the emissions of the companies that appear to be reducing their carbon intensity, you see that, as expected, the use of enterprise value, including cash, does favor companies with good financial momentum, and there may be very limited relationship to changes in underlying emissions. So here I looked at we looked at all the companies that had a reduction of 7% or more in carbon intensity. So companies that will be very attractive to build your index in any given year, since you are expected to reduce the intensity of the portfolio by 7%. Companies that are that have reduced by 7% their carbon intensity will be attractive. You find that only 45% of the companies with 7% reduction or more in intensity have a 7% reduction or more in emissions. And 30% of the companies on average since 2014, in fact, had an increase in emission. So that's 30% of the companies that were showing a 7% reduction in carbon intensity measured with EDHEC. If you had kept the traditional normalization factor revenues, the numbers would have been much better. 60% of the companies with 7% reduction in revenues-based intensity have reduction in emissions of 7% or more, and only 18% see an increase in emissions. And by the way, you may object that it's a good thing for a revenues-based emissions to fall, as it shows a progress in efficiency of the company. So in conclusion, this shift of metric has reduced the transparency and comparability of disclosures, since we have different metrics for different indices, including within the same asset class. It has introduced equity market biases into index construction, and equity market volatility in the measurement of carbon intensity, which weakens the link between intensity and emissions and facilitates greenwashing, since you are incentivized to use those companies with a high reduction in intensity, and this is very weakly linked to reduction in emissions. Again, the objective of the regulation was to direct capital towards companies that were reducing their emissions year after year. So what can investors do with that? The investors should look at the index methodologies and check the extent to which climate metrics that are at the core of portfolio construction are of a nature that can reward the corporate climate efforts. It's fine to use EDHEC for reporting, but you should avoid driving your portfolio construction in terms of stock selection by EDHEC. So you could use a different metric for selecting and weighting stocks, a metric that would be more closely associated with emissions, like the carbon intensity measured against revenues. And this would allow you to better promote decarbonization in the real economy when you invest in a CTB or a PAB index. Thank you.
Thank you very much, Frédéric. There is no questions, so we can move on to the next presentation by Erik Christiansen.
Okay. So I share my screen.
Yes, please.
Yes. Okay, so this article was about ESG engagement and divestment, asking the question whether these two approaches were mutually exclusive or, on the contrary, mutually reinforcing. And the motivations for the article was threefold. First of all, we wanted to dispel some misconceptions or commonly held views about engagement and divestment. The first one being that the two are incompatible. So meaning that if you want, some people claim that if you want to engage with companies, if you want to be an active shareholder, you need to remain a shareholder of the company in order to engage with it. And this sounds like an obvious statement, that to be an active shareholder, you need to be a shareholder, but we'll go into that because it's actually not true. And the second idea we wanted to dispel is the idea that divestment is a passive approach, in the sense that it doesn't have any impact on companies. It doesn't influence their behavior. And people claim that divestment is a bystander approach, as opposed to, let's say, an active ownership approach. So these two ideas we wanted to dispel. We wanted to show, on the contrary, in which way divestment actually could influence companies, which levers, which mechanisms were at play. And lastly, we wanted to compare divestment strategies, straightforward exclusion strategies, to other popular ESG strategies that try to mix or combine ESG data, ESG signals, ESG scores, for example, with financial signals such as factor scores or factor attributes, and build, let's say, optimized portfolio, mixing ESG and financial elements in one go and optimizing the portfolio. So we wanted to compare this approach to our filtering or divestment approach when it comes to their capability to influence corporate behavior. So first, in terms of results, we looked at some of the mechanisms through which divestment influences company. And basically, there is a lot of theoretical and also some empirical literature around the point that divestment influences companies by raising their cost of capital. And this happens in two different ways. First of all, by divesting, so actually selling stocks, you raise the amount of stocks available in the marketplace. So you basically increase supply, which leads to lower prices, lower stock prices being the equivalent of higher cost of capital for companies. But there are also an important indirect effect, which we can call the signaling effect. So by making, let's say, public, vocal divestments, companies or investors also signal to the market that the riskiness of these companies is changing. So it contributes in particular to the normative process and creates new norms, new societal expectations. And basically, public divestment campaigns threaten the license of operate to companies, raising their expected riskiness, thereby raising their required return, or which is the equivalent of their cost of capital. So this signaling effect is extremely important, and this is also, the signaling effect is also what differentiates a straightforward divestment strategy to other, let's say, combined or mixed up strategies, in the sense that divestment sends very clear messages. Basically, if the company doesn't meet your ESG requirements, you sell the company. That's a very clear signal, and the goal you're stating is completely in line with the investment decision that you're taking. You're selling the stock completely, and this is opposed to other strategies, as we will look into in terms of signaling, and therefore on the impact it can have on companies. So here in this example, we look at the strategy where a very simple example of mixing strategy, where you mix a financial signal, in this case simply the market cap weight, with an ESG signal, in this case a carbon intensity, which was what Frederick just mentioned. So carbon scope 1 and 2 emissions divided by revenues. So mixing the two simplest forms of financial and ESG signals, and building a portfolio based on that. And what we can see that, so this overall portfolio, you could say that this is a low carbon portfolio, because it seeks to, let's say, lower the overall carbon intensity of a portfolio. But when you look at what actually happens at stock level, you can see some contradictions. So first of all, you can see in the middle column the percentage of what we call deteriorators with increasing weight. So these are companies whose carbon intensity increase from one year to the other, and at the same time their weight in the portfolio increases. So again, if you are an investor applying such a strategy, you state as your goal that you want to decrease carbon intensity. You want to reallocate capital to carbon efficient companies. But at the same time, what's actually going on in your portfolio is the contrary. In many cases, you increase the weight of companies with deteriorating carbon intensity. You can also see at the right column the percentage of the worst emitters with increasing weight. So here we look at not the deteriorators from one year into the other, but the worst emitters in terms of the 10% worst carbon intensity. And we see that even among the really worst carbon intensive companies, the weight can increase from one year to the other. So again, you purport to, let's say, move away from extremely carbon intensive companies, but what you're actually doing from one year to the other is increasing the weights. So this means that the overall goal that you're professing and the overall goal that you try to discuss with companies when you're engaging with them, the goal of the dialogue of investors with companies is in complete contradiction with what is actually happening at their within their portfolios, and this lowers the effectiveness of their engagement policy. We'll show in this slide another example. So instead of here we have a slightly more, let's say, what people would call a slightly more sophisticated approach. We do an optimization of low carbon and factor strategy. So what we try to do is we look at the factor scores and at the same time at the low carbon scores. And we do a combined score. So we multiply the low carbon score by the multi-factor score. And we do an optimization whereby we maximize this composite score, given that we should have a tracking error level, which is in line with a much simpler approach to building a low carbon multi-factor strategy, which is divesting from the high carbon stocks and then applying a multi-factor strategy within this filtered universe. This is what scientific beta would do. But here we compare an optimized approach with the same level of tracking error as our approach. And what we can see again is some contradictions in terms of signaling. So we see that, again, the worst emitters, the most carbon intensive companies, their weight can increase from one year to the other. And even in some cases, the weight of these worst emitters is higher than in a cap-weighted benchmark, which means that basically the factor scores, the factor attributes of the stocks can in some cases be so good that even with an extremely low carbon score, the composite score still leads the optimizer to pick this as one of its top stocks picks and stock weights. So again, in conclusion, what we have seen is that in order to be effective in a low carbon or ESG strategy, you don't only need to have, let's say, an overall goal, for example, having an overall carbon intensity reduction, which is of course a good thing. But as Frederick also mentioned earlier, it's not enough. You need to look at what actually happens at the portfolio, at the stock level within when you're making portfolio decisions, to see whether these overarching goals that you have, these stated goals that you try to inculc on companies, whether these goals actually translate into investment decisions that are in line or aligned with your goals, because only by aligning your investment decisions at stock level with your overall goals can you have a clear signaling on companies. And what we have seen is that this signaling effect is perhaps the main lever through which an ESG strategy actually influences corporate behavior. So whereas an ESG filtering approach or exclusion approach or divestment approach, these terms are equivalent, sends a very clear message to companies. Other approaches, in particular optimization approaches, where you mix the two types of data, ESG data and financial data, they can send very blurred and inconsistent messages, and therefore have completely inefficient engagement policies. They're inefficient ways of engaging with companies and trying to change their behavior. So this is the conclusion of our this article. And Severin, if there are any questions, I would.
So one question: does the fact that one investor sells its stocks really affect the stock's price? Sorry.
Okay, so this is. In theory, you would need a certain number of investors in order for the, because if it's a very small marginal sale And if the selling decision doesn't really include any new financially relevant information, there should be no impact on the stock price. But if there is a sufficient critical mass of investors divesting, and if this divestment actually sends new signals to the marketplace, and as I said, the signal could be higher expected riskiness, because the actual point of divesting is part of a normative process. So if there's a critical mass of investors sending clear signals on the riskiness of companies, there can be an impact on prices. Researchers have pointed to the critical mass being around 20% of total investors, which sounds like a high threshold, but probably for some divestment issues, for example, coal divestment, as we've been talking about earlier, we're probably approaching this critical mass. And this means that also from an empirical point of view, there is now some evidence that this divestment actually influences cost of capital or prices. There's been in particular one paper looking at divestment announcements, so looking at different from an event study type of article, looking at investors announcing divestments from fossil fuels, and showed an impact on stock prices. And more recently, actually, after we published this article, there was a recent paper looking at it more comprehensively from a decarbonization perspective, and they looked at mutual funds implementing a decarbonization strategy, so sales decisions targeting decarbonization of their portfolio, and they showed that empirically this had an impact on stock prices, a persistent impact on stock prices, and also fortunately, that companies actually react to this increase of cost of capital by actually lowering their carbon intensity and carbon emissions. So there is now also some empirical evidence that divestments, in particular fossil fuels or decarbonization divestments, actually impacts companies.
Okay, thank you very much, Eric. So we will now move to the final presentation by Daniel Aguet.
Yes, thank you, Séverine. Okay, so I'm going to talk of the benefits of the historical volatility adjustments risk control option, which is a new risk control options that we offer to investors since the beginning of the year. So first, why does Scientific Beta offers risk control options? Well, when you invest in factor strategies, you end up being exposed to some hidden risks that can affect the short-term performance of the factor strategies, like sector risk, market beta gap, or the volatility risk that I will explain in the presentation. So what we do is that we put a lot of emphasis on explaining these hidden risks to clients, and then to offer them ways to control for these risks. So if you look at the table, you see the multi-factor index, and you see that this index has on average a market beta gap, which is negative, which means that on average the market beta of the index is below 1, which means that investors are missing some reward from the market. The same for the volatility. You have some volatility deviations against the long-term volatility of the index, as well as for the sector deviations. You observe deviations, sector deviations. So then we offer the different risk control options to investors. And you see that when you choose the sector neutrality risk control option, you can reduce sector deviations. When you use the MBA, so the market beta adjustment risk control options, you reduce strongly the market beta gap. And we will see that when you use the HVA risk control option, you can reduce volatility deviations to be consistent with investors' fiduciary options. So why volatility risk is important? Well, here we show two measures of volatility, a long-term average volatility and the one-year rolling volatility. And what you see clearly is that the average volatility is not representative of the short-term volatility, which is the 1 year.
Daniel, excuse me, would you mind putting your screen on full screen, your presentation, because it's not on full screen. I'm sorry. Thank you.
Is it better?
Yeah, better. Thank you very much. Thank you. Sorry.
So we see that this average volatility is not representative of the true volatility risk of the strategy, which is a multi-factor index, and that there are periods where the volatility spikes to 30–40% or goes below the long-term average. So the objective of HVA, so historical volatility adjustment, is to control this volatility risk and try to make sure that the one-year rolling volatility is much closer to the average long-term volatility. So the benefits of controlling volatility. So the main thing which is really important when you control volatility is what we call conditional dissymmetry. So behind this barbarian term, it's something very simple. So in high or low volatility market regimes, when you use the HVA risk control option, you can change completely the market beta of the strategy. So in low volatility market regimes, when risk is low, you will increase the market beta strongly compared to the average market beta. And in high volatility market regimes, you will reduce strongly the market beta. And this conditional dissymmetry of the market beta allows for downside risk reduction and risk-adjusted performance improvements over the long term. And we'll see that in the next slides. So one important thing if you want to implement volatility control is a good volatility forecasting model. If you cannot forecast volatility, then don't implement volatility control. So what we do is that we use a Garch model, which are very well known to capture stylized facts of financial returns. So for instance, we can capture the volatility clustering, which means that when volatility is high, it tends to stay high, and vice versa. When volatility is low, it tends to stay low. The leverage effect, which is the fact that when there is negative returns, you have more impact on the volatility than positive returns. The fact that returns obviously are not normally distributed, so you need to take into account fat tails. And finally, structural breaks. So when you look at the long-term volatility of a factor index, it can be completely affected by shocks like the financial crisis of 2008 or the COVID crisis. So you need to take into account these financial characteristics to produce good volatility forecast. And when we compare our model, which is in the last column of the table, what you see is that compared to other more simple approach, like historical volatility, EWMA, or the VIX, we produce more robust and more accurate volatility forecast on average, or when you look at extreme statistics. So now, how do we control volatility? So we just discussed how we forecast volatility, but then we need to find a mechanism to control volatility. So the first thing is that we need to determine a target. So what we do is that we look at the historical volatility of the multi-factor index, which will be the target that we want to achieve. And then every week, we will forecast the volatility over the next week of the index. And then what we do is that if the forecasted volatility is above the target, we will invest in a cap weight overlay. And the allocation will depend on the ratio of the target and the forecasted volatility. And when the forecasted volatility is below the target, we will increase the allocation to the cap weight overlay. So this mechanism is based on a cap weight overlay allocation. So the cap weight overlay can be replicated by futures, which means that you have no additional turnover to the index. So in typical control managed volatility solutions, they leverage or deleverage the index, which means that you have turnover associated with that. In this approach, the fact that we use future, we have no additional turnover on the multi-strategy index, only turnover on futures, but transaction costs on futures are really low. So it's not really problematic. So an important also aspect of this implementation is that we have a buffer rule of 20%, which means that we will not implement every week the new optimal allocation. We will only implement it if the new allocation is above the buffer of 20%. So if there is a change, significant change in the allocation, we will implement it. Why do we do that? Simply because if you follow the standard, the optimal allocation, you will have too many small changes that will add noise to the solution. So we have this buffer mechanism to limit this effect. So when you look at the benefits of the historical volatility adjustment, so we recap the benefits with the conditional dissymmetry of the market beta, downside risk, and risk-adjusted performance. We compare the cap weight index, the standard multi-factor index, and the multi-factor index with the HVA risk control option. And so, as I discussed previously, you see the strong market beta dissymmetry. So in low volatility market regimes, the market beta of the HVA version is really high compared to the multi-factor index. And in high volatility market regimes, when you need to reduce the market beta, well, you see that the market beta is strongly reduced compared to the standard index. So this is the conditional dissymmetry. Now, when you look at downside risks, we can reduce downside risk by much. So the maximum drawdown is reduced from 51 to 31% over the sample. And when you look at risk-adjusted performance, you have an improvement of compared to the multi-factor index with a Sharpe ratio of 0.71 and 0.76 for the HVA version. So these are the three main benefits of this risk control option. And now we do a focus on 2020 with the COVID crisis. So during this period, multi-factor strategies experience an increase in the market beta compared to the average. So they were not really any more defensive. And we see that our multi-factor index had roughly the same risk as the cap weight. So what is really important to understand is that if investors want to keep the defensiveness of multi-factor strategies, they cannot rely on average measure of risk like the average volatility, but they need to explicitly control for this risk via risk control options like HVA. And you see that during the COVID crisis, the multi-factor index with this option allowed to reduce strongly the volatility over the period, the maximum drawdown, the maximum loss, and you see the impact of the mechanism on the market beta that goes down from 1 to 0.47. So to conclude, if you want to control for the volatility risk, you need to do it explicitly and use a proper risk control option such as the HVA. This is it for me. Do we have some questions, Séverine?
Yes, a couple of questions. First question is, why do you use the index volatility as the target?
Okay, so it's a choice that we did. The objective is that the average volatility of the index should be representative of the volatility risk. What we could have done is use the cap weight as a target. So for clients that want to use the cap weight, there is no major change, but you will have slightly higher leverage if you want to target the volatility of the cap weight. since on average the multi-factor index is more defensive than the cap weights.
Okay, there was also a question on whether the numbers were updated for the corona volatility.
So over the long term, the samples ends to 2019, but here clearly we show the 2020. So yes, the numbers are updated for the COVID crisis. It's the first semester of 2020, and we see the impact of controlling volatility, which is really important if investors cares about that.
Okay. Another question that just came. How differently reacts the portfolio for this control of volatility risk versus a regular low volatility factor index?
Yes, so we offer also a risk control option, volatility risk control option on our low volatility indices. So during the crisis, so low volatility indices are the same as a multi-factor index in terms of rolling volatility, if you want, except that the low volatility index is even more defensive than the multi-factor index, because its market beta can be as low as 0.7 or 0.8. So it would behave exactly the same. So if you look at our dynamic defensive offering, we can send some documents to the people that send the question. We can have the same exactly same mechanism to protect for the volatility risk, and the impact is very important.
Okay, thank you. No additional question, and we are running out of time. So in case people have additional questions, we have a dedicated email address, which is webinar@scientificbeta.com. So thank you for your time, everyone. I will be sending you the materials and recording for this webinar very shortly. And yeah, if you have any additional question, please don't hesitate to contact us. Thank you very much to you all, and we will now end the webinar. Thank you very much.